As I was looking at the title of our session, I noticed that this is probably the longest title of all the sessions in that meeting. First, I will read it for you, then we'll have to interpret it. The challenge of central banking, finding the new normal in a persistently low inflation world and navigating progressive policies and politics. So, there is a saying, I did not have time to write an article, so I wrote a book. It means really that central banks have been everything for everyone and therefore maybe penetrating into areas that are not normally their areas. We are saying the challenge is finding the new normal. It means that something got lost. It says that a problem is persistently low inflation. A few years ago, the problem was persistently high inflation. And navigating the progressive politics and policies, areas that normally policies and politics were supposed to be completely divorced in central banking. So now we need to navigate. To navigate, you need a compass. To have a compass, we need to have the clarity. And one of the things that we will hopefully obtain here today is this compass. We have with us here the most ideal panel to deal with these issues. Every one of them used to be a policymaker, and every one of them is now free from the chains and constraints of being a policymaker, which means they have the knowledge, they have the experience, they do not have the chains, and the test will be how much you are able to draw out of them. They have no excuse. I'll start from my far left, John Taylor, who has been, well, all of them have had a long career, so I will not mention all of that. John Taylor, formerly professor at Columbia, now at Stanford, but in between has been many years in policy, including Undersecretary of the Treasury, and during very, very tough periods. Stanley Fischer, again, similar profile. Used to be a professor, MIT, Chicago, went into economic policy, first deputy managing director of the IMF, governor of the Bank of Israel, deputy vice chairman of the Federal Reserve, and of course, in between trips to the private sector, whether it is Citi, and now senior advisor of BlackRock. Bill Dudley did the reverse transition. He's now at Princeton University, having been first in the private sector with Goldman, but then his claim to fame and credibility and credentials for this discussion today are many years in the Federal Reserve System, including being the president of the Federal Reserve Bank of New York. And then we have Lorenzo Bini-Smaghi, who is now chairman of Societe Generale, have had long career in the policy arena, in the managing council of the European Central Bank, director general of the Italian Treasury, was at the Banca d'Italia, and of course started his career at the University of Chicago. So with this panoramic view of our panel, it will be our fault if we don't get answers to the right questions. There are quite a few questions that were prepared, some were submitted. So let me start. As you know, many of the central banks today are dealing about the framework of what they are doing now compared with what they have done before, which is really one of the manifestation of the fact that we are searching for the right way, searching for the normal, searching for the compass. So, John, do you see the need for a more rules-based or strategic approach for the world of today. And if to make it a little easier, how do you judge the recent record compared with what your answer to the first question?
Okay, thank you. Yes.
Very good, thank you. Any further comments?
I think there's so much evidence that we need a more strategic, if you like, rules-based methodology for monetary policy, and actually it's a broader issue, but we have evidence. In the 80s and 90s, policy was fairly predictable and understandable, more strategic, rules-based, use different words, and then in the 70s, it was a disaster because of policy all over the place. And quite frankly, I think it's not mentioned enough at this meeting. There's obviously debate about it. And that is, I think, the 2003, 4, 5 period where the Fed in particular, but other central banks as well, pulled the rates very low compared to what would be the rule used to then. And I think that was largely the result. The result of that was search for yield, excesses in the housing market and financial institutions, and that finally crashed. And it was a major factor, I think, in this unbelievable experience we had, tragic experience we had in the great financial crisis, global financial crisis. So I think we have evidence. I think there's also now, given the situation we are in now, quantitative easing, negative interest rates for $17 trillion of debt, rates held below zero in Europe, Japan, and countries that are near them, like Switzerland. And it's not really clear how we're going to get out of this. I think a lot of that has been because of exchange rates. That's also not mentioned enough. There was explicit mention in the case of Japan and Europe and their quantitative easing. And you can see it in small open economies all over the place. So we're not in a good situation. I think you have heard from some of the central bankers who have cried out, if you like, for a more strategic way to do things. Raghu Rajan, when he was Governor of the Reserve Bank of India, you hear Mario Draghi say it sometimes, Paul Volcker. And I think in terms of the second part of your question, Jacob, I think there is some signs, are some signs which are promising. I think the Fed in the last 2017, 2018, Stanley was there for part of this, began to write in their semi-annual report specific numerical rules. That doesn't mean they'd follow them, of course, but they were used for a conversation and how the Fed was different from those. And Stanley gave a speech in 2017, Janet Yellen gave a speech in 2017, and those continued, and Jay Powell became the chair. He said, I find these rules helpful in making decisions, and then there were various appointments of people who sort of felt the same way. You had speeches, and I think most important, you had the actions, the beginning of a move towards, I would call it, normalized policy as rates began to creep up in 2017 and 2018. It's not clear right now, and I think that's what we should be discussing. Should we go back to this, or are we in a new world?
Thank you, John. The style of our deliberation here will be relatively brief answers as you can, so we can have interaction and move on. So I'll jump on Stan, because since we spoke about framework, and Bill, I know that you were talking about the new framework for the Federal Reserve, and since you were there also in the old framework of the Federal Reserve, maybe you can tell us what is the difference, and are we in the right direction? And if you can do it briefly, please.
So the old framework was you didn't pay interest on reserves, and that meant you had only a very tiny amount of reserves in the system, and every day you had to intervene in the open markets to make sure the amount of reserves in the system was appropriate relative to the federal funds rate you were going to target. Then in 2008, as a matter of necessity, the Fed moved to paying interest on reserves. That was actually a provision that was contained in the TARP legislation. And that allowed the Fed to operate with a much larger balance sheet, which obviously facilitated very large liquidity backstops, which was helpful during the financial crisis, and also enabled the Fed to pursue quantitative easing over the next few years. And so there's a question on the table, especially given the kerfluffle we saw in the repo market recently, is the new regime a better regime than the old one? And I think the answer is unequivocally yes. What the new regime allows you to do is not have to intervene in the banking system on a day-to-day basis. That's nice. Number two, it reduces the amount of interbank trading that's necessary just to allocate reserves across the system. And three, probably the most important thing, it allows you in a time of crisis to offer unlimited backstops because you don't have to worry about having too much reserves in the banking system. And the ability to offer an unlimited backstop during times of stress is actually very, very helpful in dealing with financial stability.
Thank you. And since you're talking about the context of a crisis and what needs to be done and the need to be able to provide a backstop, we remember that in the early days of the crisis, and Stan, this is going to be addressed to you, there was the recognition that somehow the regulatory framework was either not appropriate or lax, and therefore there was a movement which received great endorsement at the end of it to have a much more concrete regulatory framework, especially more capital, more liquidity, less leverage, all the things that are very important. But along this also came other things like Volcker Rule and things of that type. Like always, crises are generating great interest, but when there is the feeling that the clouds are over, the interest in dealing with the crisis is receding. And we saw a movement to relax some of the regulations. And there is a distinction between more regulations, less regulations, good regulations, bad regulations. I know you have a view about it. Why don't you take the floor for a few minutes?
Thanks. Let me focus on the role of supervision of the banking system for central banks. Should they have that task, or should it be done elsewhere? I think there are two models. It's very hard to tell which one is correct. What is correct, though, is when you get into a crisis, the central bank has to perform extraordinarily to get liquidity into the system. My own feeling is that it should be with the central bank for a simple reason that the central bank is going to have to come in when things get bad. And if you're not the central bank, you're a little less worried about that. And what I think is happening now is very regrettable. It is extraordinary that 10 years after the start of the crisis, we've begun a march back to the framework that was in place 10 years ago. And I find this easing up on regulations which were tightened up at the start of the crisis to be very hard to believe. These crises are few and far between, so it's very hard to know what frequency of crisis you're willing to deal with. But I don't think we should have had a crisis and immediately allowed everybody to say that's fine. There is a problem in the way this problem is being handled, which is it is very much being influenced by bankers whose interest is less, and I'll say this based on my views, this is not, and nothing I say is BlackRock's views. The problem we have is that almost all the recommendations for change are coming out of people whose aim is to strengthen the financial system and to strengthen the banking system. And what they want is to have higher profits. And doing that is not a worthy goal of a regulatory system. They need to develop systems of managing that will get them the profits they need, but we need a system which does not produce repeated crises. And I think we're heading in the opposite direction right now, and that's a mistake.
Thank you. I want to, in a way, cross the ocean to Europe, but in this integrated world, Europe is impacting everything else. So Lorenzo, it's for you now. London, July 26, 2012. That's a date that is very much memorable. In the middle of the mess, when things were about to become even worse, Mario Draghi made his famous remark, and I will read the sentence: "Within our mandate, the ECB is ready to do whatever it takes to preserve the euro." And believe me, it will be enough. We are now at the tail end of 2019. It seems that the objective of preserving the euro as an entity has been achieved. There is the question of the collateral damage and things that happened thereafter as a result of the policies of the outright monetary transactions, whatever it takes to reach the 2% or a little less. Can you elaborate a little bit on this?
Well, if I can go back to this July 27, well, I don't know what you did on that date, but probably that sentence sounded quite reasonable to you, right? To most central bankers. He said something that was reasonable. And I think most of us, after having heard this sentence, started saying, and now let's see what happens. And let's see if somebody reacts. And somebody in Berlin will react. And I think the masterpiece happened because nobody reacted. And in fact, when some people try to challenge legally, at the political level, in particular in Germany, they said, this is a central bank task. So I think the masterpiece by Mario was to convince the politicians, in particular in Berlin, that this is a central bank role. This is my first comment. Now the central bank role is being challenged because somebody suggests that if a central bank has a task, achieving price stability, and if price stability is defined throughout the world as 2%, and if you are not able to achieve 2%, then let's change the target for a series of reasons. And the question I ask myself is, would this undermine the credibility of the central bank or not, if the central bank changes the target depending on whether it's successful in what it does? And I think this is the discussion that we're having in Europe and maybe in some other parts of the world. In my view, if we changed the target, this would undermine the credibility and independence of the central bank. Unless it is proved, widely in the academic circles through research that money or inflation is not a monetary phenomenon. That is, that you cannot achieve inflation through monetary policy. But if we get to that conclusion, I'm not sure that having 1% rather than 2 or 3 would make any difference. It would mean basically that monetary policy would re-enter the realm of the general government policy, and this maybe is a question for somebody else in the panel, but I think if we want to preserve the independence of the central bank, it still has to aim at a clear target. And so the whatever it takes has to be explained in terms of achieving the target. And the question is, why then are central banks not able or not willing to do whatever it takes to achieve that target? And maybe they haven't been able because they have not the right models, not the good models, and probably if you look at Europe over the last 10 years, all models in Europe have overestimated inflation, not only in the European Central Bank, but in the IMF, the Commission. So we do not fully understand how the new world is operating after the crisis, why long-term interest rates are coming down. And the result of all this, if I can conclude, is that we are living in a world with low interest rates, which are creating a series of problems, and the central bank is the main culprit, the main reason, the main focus of criticisms. Interest rates are low because of central bank policy. And I think this does not fully capture what is really happening, is that we are living in a different world. Let me give you a very simple example, 30 seconds. Look at the Bunds. 1st January 2019, when the ECB stopped QE, it was 20 basis points positive. Look at the Bund in September, before the discussion in the Governing Council, it was minus 50. So during a period in which the ECB was relatively neutral, not intervening, the Bund went down 70 basis points. This means that what is happening out there is not only a monetary policy, it's dominated by factors which are much broader than monetary policy that we need to understand to have a better feeling of what the role of monetary policy is in this new environment.
I don't want to leave this subject about whatever it takes. Because whereas the whatever it takes was coined at the beginning to preserve the euro, it got transformed in the public debate and therefore also in perception that whatever it takes to achieve 2% inflation. And that's not identical statements. In fact, as you mentioned, all central banks, all the major central banks are highlighting that number. So in the ECB, the objective is
Close but below 2%.
but close to 2% over the medium term. The Federal Reserve, the committee, symmetric 2% objective. The Bank of Japan aiming to achieve the price stability target of 2%. The Bank of England, the committee will always act to achieve the 2% inflation target. And the question is, no matter what, suppose I told you that you are pushing on a string, and as you have, and somehow you do not get the 2%, and you can go and do a lot of studies why the inflation is so low and all the rest. But if you define your objective as whatever it takes to achieve 2%, it means almost at all cost. So the BIS came by saying, don't forget financial stability, do we have vulnerabilities in the financial system that arises from exceedingly low interest rate for so long and negative rates, etc. How do you square all of this? But we don't need to, I don't want necessarily to get the European answer. We'll go around, because that's a more general question. That's the objective for all the central banks, and looks like that the financial stability is in the background but not up front. John, we'll go in this order.
So I think there's some advantage to having roughly the same target for different central banks. It provides a global system, if you like. I do think it's okay to have deviations, which are not all that sizable. It's 1.7, 1.3, that's okay. I just think that maybe we're taking the numbers too seriously, and I think a danger that takes emphasis away from how you achieve the numbers. So I would think of it that way.
Stanley?
I agree with John fundamentally. But I'd like to emphasize, this is, I think, the first time in history that all the major countries have the same inflation target. And that's a very important achievement, because that says we now have a definition of what is monetary stability or zero inflation, or at least an agreed inflation target. And I think that's an enormous achievement. It wasn't aimed for. It just turned out that way once New Zealand set the example. What is a matter of concern is what rule you're going to use to get what sort of 2%. And I think the sort of 2% we want is something with a slightly longer average. There are papers being written at this moment which say, take your time. The Australians have done that forever, but they happen not to have had recessions during that period, so it's a little hard to know exactly what the Australian achievement means. But I'd end up with what John said, that there is an advantage to having countries have the same aim and the same rates of inflation.
I must rephrase my question as we move on. The question was not, is it good to have an inflation target, and is it good to have it common across the world? But how do you achieve it, and at what cost, has also to be articulated. So when I left the room, I met somebody from the insurance industry who told me, ask them what happens to whether they take into account the fact that zero interest rates is hurting the performance of the pension system, the insurance system, not as a lobbyist for one's industry, but as somebody who cares for the financial system, because at the end of the day, monetary policy operates through the financial system, and if it is weakened, it reduces the effectiveness. So my question again is, if you see that under the current policies, you push on a string and inflation is not picking up, should you push more on the very same string, or should you look for something else? Because in the meanwhile, financial stability may be hurt. So this is really the question that is in the air. Bill.
So I think in the United States, I mean, the problem isn't that severe because inflation is actually pretty close to the target, and while inflation expectations are a little soft, they're not truly unanchored to the downside. But in other countries where inflation expectations have fallen, that's really serious because that's a de facto tightening of monetary policy. I think in the U.S., the big change that the U.S. I think is highly likely to make is to move away from the bygones policy. The bygones policy is if you miss this year, next year, 100 years, 1,000 years to the downside, the next year you target 2%. And the problem with that framework is it means that if you do that consistently miss to one side, inflation expectations are going to drift down, and that's not desirable. So I think the Fed is going to move to an average inflation target and make it very clear that we're actually quite happy if we've underperformed 2% for a while, that we're actually willing to have inflation a little bit above 2% for a while. And that will be, it's not a big change, but it will help keep inflation expectations better anchored. And I think that would be an improvement to monetary policy. Second change I think the U.S. is going to make is I think they're going to introduce a range around the inflation target. The reality is the Fed doesn't have that tight control of what inflation is going to be on a month-to-month, even year-to-year basis. And so being a little bit more clear about that by having a range, I think, would be helpful in the implementation of monetary policy. But the U.S. problem is small compared to the problems in Europe and Japan.
Absolutely. Which brings me to Europe.
Yeah, which means that if the Fed has been able to be close to 2%, it means that others should be able to do, depending on what you have done before. The point is, in economics, you always have to try to think symmetrically sometimes. And let's go back to the end of the 70s. Weren't people discussing exactly the same issues in symmetrical terms? That inflation was going up, monetary policy was tightening, and there were problems of financial stability in the US, all over the world. And some people, including at the Fed, were saying, we are losing control of inflation. It's not a monetary policy issue.
Shouldn't we be smarter by now?
And then came Paul Volcker. And he said, if we want to achieve stability, we have to go and do it.
Right.
And he did it. And he probably create problem in terms of financial stability. And he said, that's the problem of politicians. They have to put, of the regulators, and so on and so forth. So my fear is that we are not achieving 2% because we are not willing to do whatever it takes. And probably if we go back in the Eurozone and think about it, we probably started QE too late. There were institutional problems in doing that. We thought that going negative on interest rates was a way to avoid doing QE. And then a kind of hysteresis has been created. And of course, fiscal policy has not been supportive. So I think that it would be a mistake, looking at the history and at what the end of the 70s debate, now to go the same direction as some were suggesting at the time, to give up on monetary policy and to accept whatever inflation is produced by other phenomena. I think we need to re-anchor inflation expectations very strongly, and in doing that, we need to convince also the politicians to do their own part. And the kind of policies that have been implemented have created enormous space for fiscal policy to act without destabilizing the fiscal position. So in the end, I would tend to think that you can work at the margin, but sticking to 2% inflation is very important. Otherwise, you really risk losing credibility for monetary policy.
Can I take 15 seconds? I mean, I agree with Lorenzo, but I think that there are limits to what monetary policy can do, and I think central bankers need to be clear about that. And at times, they actually do need help from the fiscal authorities. And when they do need help from the fiscal authorities, I think they should be clear on that point.
John?
So you, Jacob, you rightly made sure we said something about the interest rate level itself, and maybe it's too low. I think that having a 2% inflation target is fine, but as Stanley says, how do you get there? And I think that's where some kind of strategy or rule comes into play. It could be that the negative rates are counterproductive. People are starting to find that. It could be the massive amounts of QE is counterproductive. People are beginning to say that. We don't know. But it could very well be that a more normal monetary system where rates are more normal will be better for the economy, will be better for inflation. We don't know. I would prefer, for the reasons you say partly, that we return to some kind of normal policy globally.
So, Lorenzo, you said something to the effect that we need really to influence or tell politicians that they need to play the role. As we stand now, normally I see the headlines that politicians tell the central bankers what they should do.
Well, they tend to be more vocal, especially this side of the Atlantic. But in the end, I gave the example of the Bund, how the Bund performed between the beginning of the year and September, while monetary policy was neutral. And this tells us something, that we are living in a world where probably due to the excess of saving, overinvestment, to the slowdown of the economy, the demand for bonds is higher than the supply of bonds. And for the German saver, this is very bad. But the German saver is part of the action because it is demanding. He or she is demanding bonds. So the only way out is to increase the supply of bonds if you want to live in a normal world. In a positive interest rate environment, you need the supply of assets to go up. And the only way to have that is to have fiscal policy being more supportive of monetary policy. And if fiscal policy in Germany and in other countries is not willing to do that kind of job, it's too easy to blame the central bank. There is a Chinese say that when the wise man points to the moon, the fool looks at the finger. And I think we should look at the moon. And the moon today suggests that we have an imbalance between assets and savings and the demand for assets. And the only way out for the financial industry, for insurance, is to have a bigger supply, in particular of safe assets like the Bund.
Stanley.
Well, I think we should just all accept that monetary policy by itself can't do everything. And it's not an accident, and several of us have written textbooks around here. Chapter 1 or Chapter 2, monetary policy. Chapter 3, fiscal policy. We never quite get to fiscal policy in practice. And then I think there should be another one, regulatory policy, as the fourth chapter. That framework can be made to behave reasonably well with predictable, if there's predictable monetary policy. And we need to think of that. Now, I need to refer to a paper which is written by Philip Hildebrand and Jean Bavin and Elga Barch and me, which tries to make a case for for monetary financing of fiscal policy, and I think does it fairly well. We've got to get it easier, got to make it easier for politicians to run fiscal policy when monetary policy is essentially not operating well at the time. And I think the same thing is true of regulatory policy as well. It needs to be part of the whole framework of what the financial system, control system is.
I want to have a little bit of a reflective question. And now that you are out of the chains, you may be more free to tell us. More than 10 years ago, when the launching of the unconventional monetary policy took place, with extraordinary good results in the early phases at least, if you were asked at the time, how long will be this detour into the unconventional territory, most people tell me that they never expected that more than a decade later we will sit here and not only stop talking about exit, but talking about the new normal of what earlier was defined as a very unconventional. So can you reflect a little bit on this in this regard? Is this good, bad, that's life? How should we think about it? I'll start with Bill.
Well, I think the lesson of the last 10 years, frankly, was we were a little slow to respond aggressively. So if you think about quantitative easing, the third round, that was open-ended. It was $85 billion a month until it actually achieved the objective. And that was more effective than the earlier rounds, which were of finite size. I think what we've learned is expectations really matter. And you really need to work on expectations. So, coming back to this fiscal policy issue, having a more stronger automatic fiscal stabilizers, I think would be really helpful because people would know going in that there's something to actually prevent the recession from being a deep one. I think that basically in the U.S., we were surprised by the fact that fiscal policy was, reversed so quickly early on in expansion. That sort of undercut the effectiveness of monetary policy early on. And I think we were also surprised by the fact that you could get to this level of unemployment without actually having an inflation consequence. That's actually a good thing. I mean, the fact that you have more people employed today without having an inflation problem is actually a good thing rather than a bad thing. But, on balance, I think that, it worked out relatively well in the United States. We have tools now that we didn't have before. We understand how those tools operate a little bit better. And we also understand that the monetary policy can't do it all, so there is a role for fiscal policy.
John, do you agree that one should have done more of the unconventional and faster, or how should we?
No, I really don't. I think in 2008 there was a need to provide liquidity, and the Fed did that quite well. But then it continued, and there's a lot of studies that say it really wasn't effective. Jim Hamilton, the most recent, said the interest rates went the wrong way at each time of quantitative easing after that initial one in 2008. So I think there's real questions about it. That's one of the reasons why I think we should get out of this mode. It's a distortion. I would also, I think, add that there's an international aspect of this. It's not just the Fed with QE. It's not just, and there's a connection. And I think the exchange rate provides that connection. And that's not appropriate. It's really a bigger than neighbor currency manipulation, whatever bad word you want to think. But it has that element of it, and I would like to get away from that because I think it's influencing monetary policy.
So the objective at the time was to avoid the further collapse of the world economy. Now we are where we are, and there are so many discussions about Quo Vadis the world, where does the world go, where does the US go, are we on the verge of a recession? What should we look about it? In some of the panels in the previous sessions, there was a consensus that yes, there is a slowdown, but put it in perspective. And clearly, definitely, if you look through the angle of financial markets, you get a different answer than if you look through the angle of manufacturing, for example. And so where are we? Are we on the automatic pilot towards a recession? The inverted yield curve clearly tells us that that's where we go, or is it something else?
But can I interject with John? We need counterfactuals. We need an alternative. So, if I asked you, well, if in Europe the ECB suddenly raised short-term rates, so we went back to zero, would we have lower long-term rates or higher long-term rates? Because that's the whole question. We need, my impression is that we may have even lower long-term rates because the economy would probably slow down in the short term. The exchange rate.
I think it depends on what the expectation is for the next.
Yes.
If the policy is supposed to be, if the policy is likely to work, if people think it's going to work, long-term rates might actually go up, and that's actually might be a good thing.
Well, so it depends on many things, but you could have that in the short term the effect is opposite as in the long run, and you need to have a model to justify this. But my impression is that unless we think that the current environment is very similar to the environment right after the crisis or before the crisis, which it is not, I think we should not be that shy in thinking about having new instruments being part of the central bank toolkit. And maybe one of the problems has been in saying that these instruments were temporary. If I think back to the ECB, we did many things saying, well, but this is temporary. We will exit.
Well, normalization was maybe not the right word to use.
Yes, exactly. Normalization, we use the word normalization maybe excessively, and in fact, the consequences might have been a kind of hysteresis in the price level and in expectations.
Well, it implies what you're doing today is abnormal, and that's bad. So it's a sensible.
So exactly. So it's
So I just want to have a quick answer still. Are we on the verge of a recession? And it's not good enough to say after more than a decade of recovery there will be a recession. That's not what I'm asking. Are we now on the verge of a recession in the next 1 or 2 years? Is the yield curve indicating this direction?
So Jacob, tell me what President Trump's going to do on U.S. trade policy, then I'll answer that question.
Okay. No, but that's a very
maybe,
good answer.
maybe, Jacob, the question is, if there is a recession, what would monetary policy do? And it's clear to me that in the U.S. case, the Fed will start QE again, and fiscal policy.
You don't have the room that you had at the time.
The yield curve is not sending.
Sure?
The yield curve is not sending the right signal right now because the yield curve is flat typically because monetary policy is tight, and the economy slows because monetary policy is tight, not because the yield curve is flat. Right. Monetary policy in the United States today is not tight, and as way it's proof. Look at what's happening in the U.S. housing sector. It would be pretty remarkable if the U.S. housing sector was recovering at a time that monetary policy was tight. So the yield curve is flat because people basically view bonds as a hedge against bad economic outcomes. If we get more inflation, that will tend to change, could change relatively abruptly, and then bond yields will go back up and we'll have an upward sloping yield curve again. But the yield curve is not the right signal to worry about recession. If you're worried about recession, I think you need to be worried about uncertainty about trade policy, whether the second round of tariffs get implemented against China. If that happens, that's a really big deal, and if it doesn't happen, that's a different path.
One of the arguments that was made that one of the reasons why long-term rates are so low is that central banks have loaded their balance sheet with huge long-term assets during the post-crisis.
That's part of it, for sure.
John.
I think it's important to take other policies into account as well. And regulatory is an important part, but there's been big changes in regulatory policy in the U.S. Stan complained about some of them, but many of the other ones are quite favorable, I would say. Considering cost-benefit analysis in a more favorable way, that is pro-growth. And I would also include the tax reductions, the tax reforms. Very important positive thing, which makes the economy stronger than it otherwise would be. So I actually worry about the deficit, $1 trillion a year, so think about that a little bit when you're thinking about monetary and fiscal policy together.
Stan.
What Lorenzo said about Trump is something which we professionals somehow think it's not quite dignified to talk about that. But it's critical. We're in a period in which we are destroying the framework in which monetary policy, international monetary system was based. We're just doing it right now. The United States is giving up. It's no longer the hegemon. Somebody else can be the hegemon. Who's it going to be? I don't know. Nobody else does. So we have an enormous increase in the amount of uncertainty in the system. And I think it's natural that we're not actually clear where we're going at the moment.
And that's why people are buying safe assets. And that's why the interest rate is going down on safe assets.
That's why they're trying to
And it's
do it.
outside the control of monetary policy.
And the memory of the last downturn, I think, is also affecting people's, making people more anxious. You saw that when we had the little upward pressure in the repo market, which was totally benign, and people were worried that that was the canary in the coal mine, like what we saw in 2007.
So as one looks into frameworks, occasionally when you don't find anything on your bookshelf, you start looking under the rug. And
Find
so
dirt.
we have the last couple of minutes, so I just want to have a very quick, almost 15 seconds or 20 seconds reaction to the following. MMT. Who is on first?
Only 2 minutes?
No, yes, yes. If you need more, then you don't have a clear answer.
Terrible idea.
Okay.
No, but do we need
MMT
it? Do we
to those who
need
don't know.
Right.
Modern
The
monetary
coordination
theory.
of monetary policy with fiscal policy is fine, but MMT just takes it way, way too far.
with interest rates which are so low? Do we need MMT? I mean, if the fiscal doesn't want to do what it has to do with negative rates, it will never do it, unless the central bank takes over Treasury, which is not, I guess, desirable. But I think the conditions are there for fiscal to do sensible things. So I think MMT would be structuring and forcing a relationship between fiscal and monetary policy, which is undesirable, and then we would not know how to get out of it. That's for sure.
Stanley?
The basis of MMT, there is
Kernel of truth.
a kernel of truth in it, and that is that there are times when you can simply print money without creating inflation and so forth. They seem to think it's always. Right. It's not always, and if you keep doing it, you're going to get inflation. But there is something there as long as you keep it under firm control, and we don't have any mechanisms for firm control at the moment. Except how monetary policy is run, and that's not sufficient. So I think it's something we ought to take into account. We ought to remember that that's a possibility, and then we better remember that it doesn't finance the whole economy, and it doesn't say we don't need any more taxes, because after all, we can always print money.
You know, that's the danger of it, that it's sort of a free lunch, right? And there is no free lunch in economics that I'm aware of.
John?
The joke is it's neither modern nor monetary nor a theory. I think there is a question about independence. Stan raised it, others have raised it. I think that, to me, it shouldn't have independence to do anything. It's independence to have a good policy, independence to have a strategy, a rule, however you want to do it, and that should be the discussion. What is the central bank? I don't think MMT is the way, but I think there are other ways that we've had lots of experience with that could work.
Very good. So I think that we just landed safely at the end of the session. Please join me in thanking our panelists. Thank you very much.